All right, let's talk about On. You know, the high-flying sportswear brand that's everywhere right now. Well, they just dropped their Q2 earnings, and they had their best sales quarter ever. So why in the world did their final report show a huge multi-million dollar loss? I know it sounds kind of impossible, right? But it's true. And over the next few minutes, we're going to dig in and solve what I'm calling On's profit paradox. And look, right from the get-go, the company's co-founder, David Alleman, basically tells us how to think about this. He's saying, hey, our results prove we're playing the long game. The key thing to grab onto here is that they're not just chasing trends or obsessing over one quarter's numbers. Nope, they're trying to build a brand that's going to be around for decades. So that's the lens we need to use as we unpack all of this. Okay, so first things first. Before we get to the confusing part, let's talk about just how good the good part of this report actually was. Because honestly, on the surface, OnGuard isn't just growing, it's absolutely exploding. So get this, for the second quarter of 2025, On pulled in a record-smashing 749.2 million Swiss francs in net sales. And yeah, since they're a Swiss company, that's their home currency. It is just a massive number, and it shows you the kind of insane momentum they have right now. And to put that number into perspective for you, that's a jaw-dropping 38.2% growth compared to this time last year. Now, that's what they call at constant currency, which is just a fancy way of saying they've taken out the wobbly effects of exchange rates to show you what the real business growth looks like. I mean, in this economy, that kind of growth it's almost unheard of. So everything's looking amazing, right? Well, not so fast. This is where the story takes a really sharp, kind of confusing turn. Because buried deep under that spectacular sales number is another figure that honestly seems to make zero sense. Instead of a profit, On actually reported a net loss of over 40 million Swiss francs for the quarter. And think about that for a second. That is a massive swing from the 30 million profit they had this time last year. Wild. So here it is. This is the big question we're here to answer. How is that even possible? How can a company that's growing that fast end up losing money on its bottom line? I mean, it just seems to fly in the face of basic financial logic. All right, to figure this out, we have to do a little detective work. We've got to look past that headline number, the net income, and really understand how the company itself measures its actual performance. This is where things get interesting. Okay, the key to this whole puzzle is a metric called adjusted EBITDA. Now, I know that sounds super complicated, but the idea behind it is actually pretty simple. Think of it as a way to see how healthy the real business is, the part that's actually selling shoes and clothes, by stripping away all the financial noise. Stuff like taxes, interest payments, and this is the crucial part for our story, some specific accounting adjustments. And check out this contrast. It's pretty stark. On one hand, you have that net loss of almost 41 million. But then you look at their adjusted EBITDA, and it's a super healthy, positive 136 million. These two numbers are telling completely different stories about the same quarter. The entire mystery is right there, in the gap between those two figures. And this table, right here, this is basically the smoking gun. It's what's called a reconciliation. It starts with that net loss number up at the top, and then it adds back a few things to get to their real core profit down at the bottom. And just look, what's the biggest thing they add back? It's this line right here, foreign exchange result. Almost 140 million Swiss francs. That one line item, all by itself, flips the entire story from a big loss to a massive operational profit. So what the heck does that even mean? Well, to put it simply, On is selling stuff all over the world, right? But because they're a Swiss company, they have to report all that money in Swiss francs. And when the currency exchange rates shifted in a bad way, the value of all that money they made in other countries, it dropped. But only on paper. It wasn't because they sold fewer shoes. It was just a weird accounting thing that happens when you convert currencies. It was a paper loss, not a real-world operational loss. And just like that, mystery solved. All right, so now that we've cracked that case, we can get back to the real story here, which is way more exciting. What is actually fueling all this incredible momentum? I mean, where is all this growth actually coming from? First up, let's look at how they're selling. For any modern brand, the holy grail is direct-to-consumer, or DTC. We're talking sales from their own website, their own stores. Why is that so important? Well, it means higher profit margins and, maybe even more importantly, a direct connection with their customers. And for On, that channel is on fire. It grew by over 54%. That just blows away their still pretty good growth with other retail partners. And this isn't just happening in one place. This momentum is global. Yeah, growth was solid in places you'd expect, like the Americas and Europe. But the real jaw-dropper? The Asia-Pacific region. Sales there didn't just grow, they more than doubled. In 1 year, we're talking an unbelievable 110.9% growth. This proves it's not just a Western fad. On is quickly turning into a true global powerhouse.
And it's not just about the shoes anymore either. Sure, their main footwear business grew by a really impressive 36%, but look at everything else. Their apparel line, up over 75%, and their accessories, get this, up a staggering 143%. This is the proof right here. On is successfully making that jump from being that shoe company to a full-on, legitimate sportswear brand.
So let's recap. The real business is incredibly strong. That scary-looking loss, just a weird accounting quirk. And because the business is so healthy, it gives the company a ton of confidence for the rest of the year. And they're not just saying it, they're backing it up. On has actually raised its forecast for the whole year. They're now expecting even higher sales growth, better profit margins, and a more profitable operation overall when you measure it by that all-important adjusted EBITDA margin we talked about. This is about the clearest signal of confidence a company can possibly send to the market. So there you have it. Behind a really confusing headline, we found a business that is just firing on all cylinders. On has definitely proven it can run a fast sprint. But what this report and their whole strategy really shows is that they're built for the long run. The marathon is just getting started. Which really just leaves us with one big question. What does that next finish line even look like for them?